you're bleeding thousands of dollars right now to the ATO without realizing it. Your hard-earned wealth is melting away inside underperforming industry funds or overpriced retail funds. If you're over 45 with more than $300,000 in superannuation, you're the prime target for an institutional tax mugging this EOFY. But don't panic, because today you're going to learn how to legally shield an extra $120,000 from the taxman using advanced pre-tax strategies before the clock strikes midnight on the 30th of June. Remember, this is general information only, does not constitute personal financial, taxation, or legal advice, so always consult a professional. There's a massive wealth loophole waiting for you, but only if you know how to play the game right now. Let's talk about the raw technical mechanics dictated by the ATO for the 2025 to 26 financial year. The official concessional contributions cap has jumped to $30,000, meaning you can inject pre-tax dollars into your fund and watch your taxable income plummet. If you're sitting in the 37% or 45% marginal tax bracket, every single dollar you salary sacrifice into your super drops your immediate tax liability significantly. Instead of paying nearly half your earnings to the tax office, you're redirecting that capital into your own wealth engine, where it's only taxed at a flat 15%. It's an absolute no-brainer for high-income earners looking for institutional efficiency before EOFY. But the real magic happens when we look at the carry-forward rules. If your total superannuation balance was under $500,000 on 30th June of the previous year, you're eligible to weaponize your unused concessional caps from the past 5 financial years. This is exactly how the top 1% manage to dump massive lump sums like $120,000 straight into their superannuation in a single year, completely wiping out their personal tax bill for that period. Imagine wiping out a massive chunk of your taxable income legally while building a rock-solid retirement nest egg inside your industry funds or retail funds. It's a completely legal framework that the wealthy use year after year while regular Australians blindly hand over their cash to the government. If you're earning a high salary, your employer's compulsory super guarantee contributions already count toward that $30,000 cap, so you've got to calculate your remaining headroom with precision. You can't afford to guess when dealing with these limits, because going over means facing severe administrative headaches and losing the tax benefits you've worked so hard to secure. The ATO tracks every single cent through single touch payroll, so your numbers must be flawless before you submit your EOFY tax return. Let's look at a practical example of a senior executive earning $220,000. Who decides to maximize their salary sacrifice strategy? By setting up a arrangement with their payroll department, they ensure that a massive portion of their monthly earnings goes straight into their retail fund before personal income tax is applied. The savings are immediate, visible, and life-changing over a multi-year horizon. Stop right there. Take a deep breath and look at your last statement. If it makes you sick to see how much tax you paid last year, stop staying silent. Go down to the comments right now and tell me your biggest financial pain. Are you terrified of overpaying the ATO this June? Or are you trapped in a low-growth fund that's bleeding your future dry? Tell me right now, because I read every single comment to help you fight back. Now that you've shared your pain, let's expose the most sinister threat to your wealth this month. It's what I call the BPI death trap. Most Australians think they can simply log into their online banking on 29th June, hit transfer, and claim a massive deduction on their EOFY tax return. That's a catastrophic mistake that will cost you tens of thousands of dollars. Electronic banking systems take days to process. Financial transactions. If your superannuation fund doesn't officially receive and clear those dollars into your account by 30th June, the ATO will ruthlessly reject your deduction for this financial year. Your money will be trapped in the next financial year's calc, completely destroying your current tax strategy, leaving you with a massive unexpected tax bill. It's a brutal trap that claims thousands of victims every single year because people trust bank processing times during the peak EOFY rush. You need to clear those transfers weeks in advance to ensure safe delivery to your industry funds or retail funds. But wait, it gets even more complicated if you're a high-income earner, because the government has another weapon called the Division 293 tax. If your combined income and concessional contributions exceed the threshold of $250,000, the ATO hits you with an extra 15% tax on your super contributions. That means your pre-tax contributions are taxed at 30% instead of 15%. While that sounds intimidating, it's still a massive discount compared to the top marginal income tax rate of 45% plus the Medicare levy. It's still a winning strategy, but you must execute it with mathematical precision to ensure you aren't overpaying or triggering unnecessary penalties. Many high earners panic when they receive a Division 293 assessment notice from the ATO, but you can choose to pay the tax bill out of your pocket or have it deducted directly from your super fund balance based on your cash flow requirements. General information only, does not constitute personal financial taxation or legal advice. Some platforms offer automated tracking tools that alert you when you're approaching your caps, while others leave you completely in the dark. This is why managing a balance of over $300,000 requires a sophisticated approach rather than a simple set-and-forget mentality. You're building a legacy, and every single dollar saved from the taxman's grasp, compounded over the next 10 to 15 years, will define your lifestyle in retirement. Don't let lack of information ruin your financial freedom when the tools for extreme tax efficiency are sitting right in front of you today. You've got to review your fund's specific deadlines immediately, because each entity has its own cutoff dates for processing manual BPAY contributions before the financial year ends. If you miss their deadline, even by a single minute, your strategy is completely dead in the water. Here's the ultimate high-value insight that the top 1% keep entirely to themselves. You can combine your personal deductible contributions with the carry-forward rules to create a massive financial shield in a high-income year. Imagine you've sold an investment property or realized a massive capital gain on your portfolio inside the 2025 to 2026 fiscal cycle. If you don't offset that massive capital gain, the ATO will take almost half of it in taxes. By making a massive personal deductible contribution, using your accumulated 5-year catch-up caps, you can completely offset that profit. You're effectively converting high-tax personal income into low-tax super wealth inside your trusted industry funds. General information only, does not constitute personal financial taxation or legal advice, so ensure you lodge a valid intent to claim form with your fund before filing your return. If you're ready to stop bleeding money and want to keep maximizing your wealth, you need to stay ahead of the next big trap. In our next episode, we're breaking down the hidden fee crisis inside major Australian retail super funds and how it quietly drains your retirement balances without your permission. Make sure you hit that subscribe button right now to Aussie Super Secrets so you never miss an exclusive strategy. Let's protect your wealth together and build the future you deserve before the government takes their cut. See you in the next video. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.